So why is it, given that everybody believes that we're entering a period of high inflation, does the RBA not believe that? And I thought I'd talk about this this magical thing called the supply chain and how it's affecting inflation. Four times a year, the Reserve Bank of Australia provides a detailed estimate of Australia's position in the world economy and how our major economies, our major trading partners affect us and our prospects. And it also provides a detailed analysis of the structure of growth and inflation in the Australian economy. That's called the Quarterly Statement of Monetary Policy. The most recent was released on Thursday last week. So what I want to do is compare the outlook between what their outlook is as released in that statement relative to the outlook I talked about a couple of weeks before, and compare the two, and then look at the RBA's view on inflation and why the RBA view on inflation behaves the way it does. So 2 weeks ago, I did a piece in which I talked about the rapid recovery from the shutdown in New South Wales and Victoria. And in that, I said that I thought that the Australian economy in year-on-year terms would grow by 3.5% this year. The RBA, looking at the same period, thinks that the Australian economy will grow by 3%. The fact that my growth rate is slightly touch faster this year means that it's a touch lower next year. So I've got an Australian growth rate of 4.7% year on year, whereas the RBA thinks that the growth rate will be 5.5% year on year to the final quarter of next year. Now, so if you add my 2 years of growth estimates together, 3.5 and 4.7 adds up to 8.2% growth. And if you add there 3% and 5.5%, their total growth over the 2 years is 8.5% growth. So in fact, there's only 0.3 of 1% difference in the 2-year growth estimates, except mine's a little bit more front-end loaded because I think New South Wales and Victoria in this quarter will recover as aggressively as they can in the circumstances. Out in 2023, they think the growth is around about 3%. I think it's slightly higher, about 3.5%. And that's the reason I think that is because I think very high terms of trade, very high commodity prices generate a lot of investment in the Australian economy. So we have a continued expansion for slightly longer. But pretty much there's very little difference between the RBA view on growth and my outlook on growth. One of the interesting results of their outlook on growth is that unemployment continues to fall from 4.75% this quarter to 4.25% in a year's time and 4% at the end of 2023. I think at that kind of growth rates, you'll see by 2023, you'll see unemployment with a 3 in front of it rather than a 4 in front of it. So I think there'll be even more demand for labour. And that means that wages growth will be even a touch stronger than the RBA thinks. What the RBA is attempting to do, what Mr. Philip Lowe has said that he's attempting to do a couple of times, is he's attempting to get unemployment low enough that you get rapid growth in wages, and that wages grow 1% higher than inflation. And that means that real wages will be growing rapidly in Australia for the first time since the first decade of this century, between 2000 and 2010, we had quite significant real wages growth in Australia. And then that tailed away in the second decade. What they intend to do, the RBA intends to do, is to kick that off again. But what's particularly interesting and worth commenting on is the outlook for inflation, because pretty much every finance writer that I pick up and read is talking about the problems of inflation. But the RBA has the view that inflation has already peaked and is beginning to decline. Their view on headline CPI is that it actually peaked behind us, 3.8% in June, be 3.25% in December, 2.25% in December 22, and flatten out at 2.5% in December 23. Their view is that core inflation is flat right through the time. Anyway, it's 2.25% now, 2.25% next year, and gets all the way up to 2.5% by the end of 23. And given that their target range is between 2 and 3%, that means we're only hitting the core inflation target, the end of next year, maybe, and maybe the year after that. So why is it, given that everybody believes that we're entering a period of high inflation, does the RBA not believe that? And I thought I'd talk about this magical thing called the supply chain and how it's affecting inflation. And to do that, just a little bit of economic history, what's been happening in the US economy and the Australian economy since the beginning of this century. Back in the beginning of the century, we decided, both in the US and Australia, that we're going to outsource our manufacturing to China. We did that by allowing China to enter the World Trade Organization. But major concern back then was, as it appears is remembered now, was high inflation. And the idea was that if we could outsource a lot of our manufacturing goods to what was then a lower wage country, China, we could produce a lot of manufactured products at a very cheap price. And that way, if the price of those manufactured products in China were increasing at a slower rate than our general inflation was, then we could go through a period where that China was exporting deflation to the US and Australia. We were importing deflation, and therefore inflation was falling. The US developed a lot of problems as well as importing deflation from China. In the first decade of this century, 6 million American industrial workers lost their jobs and never ever got them back. And that generated a decline in the number of industrial workers in the US from 18 million to about 11 million, 12 million. And that generated a continuing social crisis in the US heartlands, which continues to this day and continues to generate political unrest to this day. In Australia, employment growth was inherently much stronger. Whole bunch of reasons for that. But higher construction levels in Australia is basically where we took up all those extra people coming out of the industrial sector in Australia. So we didn't have that problem. And but what that meant was we got into a situation where in the Australian economy and the US economy, 85% of the Australian economy and the US economy is in the services sector, not the manufacturing sector. So if we go through a period as we have in the last year, where people were locked up at home, say, and they discover Amazons to a degree in which they haven't, and they start buying goods to a high level of, to a much higher level than they previously were, and you saw this both in Australia and the US, then that generates a huge amount of imports from China. And then it's the problem of generating that volume of manufactured goods in China and shipping them to the US and shipping them to Australia and other markets. And that problem, the re-acceleration of the US economy and the Australian economy has been so rapid. As I said last year, this has not been a normal recession. This is like the recovery after a global natural disaster like a hurricane, a massive hurricane. And so the recovery is much more rapid and demand surge is much more rapid and government spending kicks it a lot faster than in normal recovery from recession. So you have this very, very rapid recovery. You have economies which have changed their structure towards importing manufactured goods. You get these incredible problems in supply chains in manufactured goods, and that generates a much higher level of inflation, both in Australia and the US. But what then happens is, as the economy slowed down to a normal pace, what you have is a resurgence in the demand not for goods but for services. And this is what we do. This is what the people in this room do. We are in the service delivery business, and 85% of the people in the Australian economy do this. 85% of the people in the US economy do this. So as the economy slows down, you move from the demand for goods to the demand for services, which is what we do. Huge demand for a huge supply of services then comes into the market at a much lower price to satisfy that demand. And that's why in the RBA measures of inflation, the headline inflation has peaks at 3.8% already, 3.25% now, 2.25% next year, and 2.5% the year after that. That doesn't mean that the US doesn't have a worse problem than we do, because their budget deficit is twice as high as ours, and that generates more domestic demand. And so I think that we're in a better position to keep inflation in check in Australia, because what I've said many times, what I think is going to be the result of the US budget deficit is that the Aussie dollar is going to go up relative to the US dollar, which means imports into Australia will put downward pressure on domestic inflation, because the Australian dollar will be tracking up. And so our inflation won't get out of hand in the way that I think the Americans can do. And so I think the American bond market is in a far more dangerous position than the Australian bond market. But we'll talk about those things another time.